Everyone said 2025 was going to be the rebound year. Interest rates were finally coming down and the worst was behind us. Buyers were finally going to come off the sidelines. And then 2025 turned out to be the lowest annual home sales in Metro Vancouver in over 20 years. Not a soft year, not a disappointing year, the absolute worst in the last 2 decades. And right now in 2026, we're not bouncing back. I'm Ruzi Najafi with the TK Group, a realtor here in Greater Vancouver. I've spent years helping buyers, sellers, and investors navigate this market. And I mean the real market, not the ones you see in the headlines. And I want to give you an honest breakdown of what the data is actually showing right now, what's happening in the rental market that almost nobody's talking about, and what it all means, whether you're thinking of buying, selling, or investing in BC real estate this year. Now, before I get into it, if you're watching this video and you're trying to figure out what's the best move that makes sense for you, your specific situation right now, I work with people on exactly that. The link to book a call with me is in the description below. No pressure, no pitch, just a real conversation about your numbers. Let's get into it. So here's where we are. Metro Vancouver in March of 2026 just posted sales that were 31.8% below a 10-year seasonal average. Think about what that means. We're not comparing to a boom year. We're comparing to a normal year, the average of the last decade, and we're running almost a third below that. The composite benchmark price is sitting at just over 1.1 million, which is 6.8% down year over year and nearly 12% below the all-time high that was set in April 2022. And active listings, we are 38% above the 10-year average right now. That is a buyer's market by the numbers, not by opinion. Now here's where it gets interesting, and this is the part that the aggregate headlines miss. The market is splitting. Condos and detached homes are not behaving the same anymore. Apartments are down 7.8% year over year, and the only segment still sliding month over month. Meanwhile, detached sales are actually up 8.3% from last March. GVR's own chief economist noted that the detached segment may be awakening while multifamily continues to slow. So if you're treating this like one market making one move, you're already working with the wrong map. On the west side, and in West Vancouver specifically, the picture is stark. West Vancouver's sales to active listing ratio is sitting at 7.5%. To put that in context, the threshold where sustained downward price pressure typically sets in is 12%. We're well below that. And now sales in West Vancouver are still 42% below the 10-year March average. These are neighborhoods that in some cases have not seen a meaningful move in evaluation in a decade. The Vancouver always goes up story? Well, the data is actively challenging that right now. Now, here's the thing I want to talk about, because I think this is where the real risk is built in and almost no one in the city is paying attention to it. The rental market. Canada is currently in the single largest rental construction boom since the 1970s. That's not a phrase I'm throwing around loosely. That is what the numbers show. And the engine behind it is CMHC's program called MLI Select. Here's how it works. A developer can come in, build a rental multiplex, and CMHC will refinance 95% of the loan to cost, meaning they're getting in with roughly 5% down. On completion, they can refinance at 95% to loan value with a 50-year amortization. This is essentially free money from the government to the private sector to build rental housing, and when you offer the private sector money, they will take it. They take it all and all at the same time. What's happening now is those projects are all completing across the country all at once, cannibalizing each other. National rent have been falling for well over a year. The performance that developers build these projects on assumed rent of $3,000 a month. In today's market, those units are only leasing for $2,600. The gap sounds small until you realize it means a CMHC refinance loan is significantly smaller than the projected, and the developer now needs to write a check, sometimes in the millions, to cover the shortfall. Of course, a lot of them can't afford it, and now we're starting to see a lot of insolvencies come out of that space. Now, here's the part that should concern Vancouver investors specifically. The money that used to chase Toronto's pre-sale condos, remember those lineups? meetups, the camping outside presentation centers, paying 30% above market because it always goes up. The capital is now flowing into Edmonton, Calgary, and the rest of Alberta. Rental multiplexes that are being sold by GTA realtors. Same playbook, same psychology, same outcome likely incoming. Alberta has no land constraints, cheap permits, and nearly 25,000 rental units under construction right now. An all-time high. Rents there are already falling, and landlords are offering 2 months free rent, gift cards, and other incentives just to fill their units. And this matters for BC because we're not immune to the same dynamics. Look at what happened in Kelowna, BC. The government came in with their Airbnb ban, blanket rule. Any city over 1,000 people, your short-term rental has to be your primary residence. Well, the vacancy rate in Kelowna at the time was only at 1.2%. The province said it was about housing affordability. What it actually did was kill tourism in a city built on tourism overnight without the ability to just build new hotels to fill the gap. The vacancy rate in Kelowna has moved from 1.2 to 6.2%, and roughly 18% of all existing rental stock in the city is currently under construction. The province's own reversal threshold was 2 years above 3% vacancy. Kelowna now qualifies and the ban is being reversed, but the supply is still coming. This is a pattern. The government creates a shortage through policy. The government then overreacts with a new policy. New policy creates an oversupply, and the oversupply creates the next problem. And the private capital that chased the incentives gets caught in the middle, of course. So here's what this all means. If you're watching this as a buyer, seller, or an investor in Vancouver right now, the resale market is going to stay range bound for the most of 2026. You have more negotiating power than you've had in years, particularly in the condo segment, particularly in the higher price ranges. If you've been sitting on the sideline waiting for the crash, this is the correction. It's slow, it's grinding, and it does not look like 2008. But that's what a real correction in constrained urban markets look like. For investors, the rental story is complicated right now, and the risk is higher than the pitch deck suggests. The deal being sold to you needs to be stress tested against the falling rents and not the rents from 2 years ago. As for detached, the buyers who have been priced out for a decade, there's a small window opening in this market that may not stay open once the rate cuts fully feed through the demand. The most expensive thing you can do right now is make a major real estate decision based on headline instead of your actual numbers. If you want to sit down and build a strategy around what makes sense for you and your situation, specifically your budget and your timeline, your goals, book a time with me. The link is in the description below. Take care of yourself and see you guys in the next video.